Hey, it's Mike Turner, and it's August 2023, and it's time to do another market update because there's a lot of stuff going on. I get a lot of questions about what uh, what the remainder of 2023 might look like, and 2024 and beyond. People trying to make decisions about real estate. You're trying to hold on until they get lower interest rates, if that ever happens. So we're going to dig in to see where the market's at and where I think it's going based on the data, right? Okay. Um, okay, so this chart's from Web Chart. This is a service you can subscribe to. They have lots of great real estate charts, and it's highly recommended. And it pulls data from the real estate MLS. I kind of circled this area right here because if you can't read the numbers, that's okay. Let me tell you what this chart means. This is covering demand, as in sales, sold units in Ada County, where Boise is at. And the red is 2023, and the teal is 2022, yellow 21, and blue is 2019. And so this chart can show you kind of pre-COVID numbers, which was really strong. Like pre-COVID numbers, the sales were just off the charts, and likely, and it was even higher in 2020, right? But just trying to get kind of a baseline of where things are and where they're going, and we are way down from kind of like pre-COVID levels, okay, and which is interesting because population is still growing here. There's still a lot of demand, but a lot of people did buy a house during the COVID years with super low interest rate and huge spikes. But demand's down. If you're a real estate professional in the Boise area, you know this. Things are just really, the market is very spongy, right? It's just like it shows some life and then it goes quiet. It shows some life and then it goes quiet. Just because the main reason is people who don't really want to buy a house right now unless they have to, because nobody really likes paying 6+% interest rate. Only people who are doing that are the people buying right now are paying cash because they're cashing out something else, or they're holding on to their property if they can because they like that low interest rate. So really, it's kind of like first time buyers and people who have to move for jobs or whatever. Okay, and here's another way of looking at the same kind of chart, just so you can see kind of how far below it. Down like near 50% ish from 2019. That's not a small number, right? It was in the it's down in the mid fours. It was in the mid eights. This time in 2019. You can see in 2021 it was still pretty high. Last year interest rates had started already coming, and last year is this teal color, and the year started off great, and then interest rates hit, spiked in May, and then here's the fall. Yeah, okay. But really, to get an understanding of, because supply and demand are the main key factors of what's going to happen with price, right? So I'm going to talk about supply and demand first, so we can get a better gauge of what's likely going to be happening in the future. Okay, all right. So this chart is from Pioneer Title, which is more of a historical chart. It covers the last 10 years. And what I like about this is that you can kind of see the longer historical trend. This is showing you how sales peak in summer and cool off in winter, and this is just a normal trend for our market. Yes, and then right here, this one that pops up real high. This is, of course, right after COVID, where COVID started, and then all of a sudden they said, okay, yeah, you can leave your houses, and people all went out and bought houses because they didn't like where they were living or whatever the case. Got sick of where their house was, and they wanted a different space. Boom, spiked demand, and then it started, and this is the start of 2022, and then it's come down from there, right? So it's just like it really dropped down, and and this purple color right here, down here, this is Canyon County, the neighboring county. So you kind of seem to follow a similar trend there. Okay, so demand it's not terrible, but it's down significantly. So we'll see what that means long term. Well, hold on, let me see the rest of the charts, okay? So this one shows you new construction only, um, and because this one, previous one, is just existing home sales. Okay, but you see a more clear trend here with new home sales. How we just went steady up for the last 10 years or so. Oh, sorry, 8 years, and then how it's been dropping the last couple here. And interesting enough, you can see in this chart down here, the purple coming up, is that now it's getting close. They're now almost selling about the same amount of new construction homes in Canyon County as they're in Ada County, which is interesting, right? Um, and so that's what's going on in new construction. I'll come back to that in a minute. Building permits. So it's kind of pre-indicator of what we might see, or kind of pre-indicator of how confident people are about the market, because if they're pulling permits, they're spending money basically, and things. And so you can see how we kind of slowly came up and then spiked during COVID, and then went down to almost nothing. And anyway, and so this is what building permits are doing. So they're way down, and there's a lot of reasons for this, right? Because interest rates are high, yes, and demand is down, and so builders are like, I don't know if I want to build, and even like people are building like even like a multifamily and stuff like that. Well, it's more expensive now to borrow the funds to build a project. It may not pencil now, so a lot of projects are just being put on hold. Supply. Okay, so I want to first cover this teal color really fast. This teal color is 2022. You can see how we had near record lows of inventory in 2022, and then interest rates shot up very, very quickly, and you can see how the market just stopped. I mean, demand stopped. And some people realized, oh, maybe this is the top of the market. I better get my house for sale. And it started shooting up real fast. And I was like, uh-oh. And so I was watching this like crazy, because during 2008, this is for resale inventory, we shot up to about 3,500 homes plus on resale homes available for sale. And you can see how we didn't quite get to those super dangerous levels. And thankfully, there's a main key reason, and the main reason is that unlike the previous bubble, in 2007, right, the interest rates were kind of not great. They were in like the 5s and sometimes 6s leading up to the last bubble. What led up to our bubble was like 3% mortgage. And so there's a ton of people buying and buying and buying, but they're all getting these super great mortgages. And so, yeah, they don't want to sell. So it's restricting the market. And this is the main thing that's keeping it from falling off a cliff and having all kinds of foreclosures and everything else. Because so many homeowners are just staying put and not wanting to sell, not putting inventory. Even if they want to sell, they can't buy anything unless they can pay cash for something. They don't want to sell because they don't want to pay like double the price with their interest rates going from being 3% to 6 plus, right? All right. Here's new construction, and you can see that on this chart it's maintaining a very healthy level. It shot up the teal again, like last year, and it had an opportunity to get to dangerous levels, but then cooled off. And some builders in the area, they really dropped their prices over the last winter, fall and winter, which really significantly pulled down the supply, and because they didn't want a repeat of what happened before. And so anyway, we're at a safe level there, so that's looking healthy. Rates. Okay, so let me just point out what I was just talking about. So the previous boom, 2004 to like 2007, you see how rates were averaging 6.76, basically the same. Yep, see the trend here? And this was should have slowed the market down, but it didn't because it was so easy to get mortgages, and the rates in the market was still screaming hot that people were like, all right, well, I'm okay with my higher interest rate because I can always sell the property and make a ton of money. So that was kind of the mentality back then. We all know what happened. Um, but since a lot of people were buying houses with this kind of high interest rate, soon as the market went over the edge, people like started walking away from their houses. They didn't try to keep them. Well, look at where these are the people who are buying, our last boom time, right? They're enjoying 3.5 and below 3, like 2.68 at one point. It's just like so good of interest rates that it just, they're going to hold on to those loans as best they can. So that's a real key difference and that's the thing that's really helping our market out. Obviously the Fed should have raised interest rates earlier. This is, kind of silly how they waited so long with the way how hot the real estate market was. And then all of a sudden they went from like 3% into this like all the way up to about 7% within a 3-month period. Like that was just dumb and ridiculous because they were just waited too long. But it is what it is. This is what we're dealing with now. So let's talk about price. Okay. All right. So with price, let me just get myself out of the way here. Okay. All right. So with price, there's a couple things I want to point out about price. This is the main thing that's reported on about the health of the market. Is it home prices up? Are they down? How much are they up? How much are they down? And this is the number one thing that gets manipulated because usually statistics are pulling from like it's up from last month, 2% or whatever the number is, right? Or it's up 8% from the month before, same month before. So they kind of use this as the overall like measure, and it's kind of dumb because it's like you can see how each month things fluctuate, and it's common for prices kind of swell a little bit in the summer and cool off in the winter. So what is the real price? So the main thing that I would recommend you take away from what's happening with home prices is just look at what was the peak, where did they go? So in this chart with existing homes, not new construction, with existing homes, the median sale price in the Ada County, the Boise area, peaked out last May around 590. Okay, and then by the winter, it was falling down into the 470s. So that's a pretty huge drop, right? That's basically 20%. When you take this number and you compare it to this number. So now, a lot of times, again, they're not doing this with statistics. I don't know why. This is the peak, and this is where we are now. So this is where we are now though is 540, right, which is down near 10, 8, 9, about 9% from the peak, which is good to know. Even though this chart says a lot of different things, it's calculating year-to-date change and change from the same month last year. Just look at where it was and where we are now to get a gauge of where the market's at, right? And this is helpful to know because we're not back up to where we were. We're not even close. So if, a year ago or last spring, a year ago plus, a realtor was telling your house is worth $600,000. Well, it probably is not worth that now, right? It's going to be something significantly less. And if you tried to sell this last winter, you certainly found out that, right? Okay. And this is new construction. They've had even bigger swings. And for example, it peaked out near 700,000, okay, and of last summer. And now, the start of the year, it was down in the high fours even, and low fives, which is basically, dropped 200,000, which is hugely significant. But again, this is median sales price. This isn't the average sale price, this is median sales price. So basically that means that this is all the homes sold. This is kind of the median price sold of homes, and it's calculated slightly differently, but still gives you a measure of where the market's at. And what happened last winter is like some of the biggest builders, like CBH, like our biggest builder in the state, just dropped their prices 20, 30% across the board pretty much, and sold a ton of homes, a lot. And they got rid of a lot of inventory because they were worried. Because back last winter, we didn't know what was going to happen to the market, if it was going to keep getting worse or get better. So that's just showing the builders being way more conservative this time around, and that impacted the median price. Where is it now? So from what I'm seeing, builders are not, have the ability to change their prices or their product, right? Because they may not be picking homes or is as expensive. They might be trying to play it safer or what have you. So it just swings a lot. And so that's why I don't pay a lot of attention to this chart personally, because you got builders building stuff at all different price points, and then they're changing their products, they're changing how they do things. So this kind of skews the numbers a lot, but we can look for overall trends, and you can see them now. Interesting enough, let me go back to the chart. See how right now it's at 544. Look at what the resale is, 540. They're basically the same. Interesting. Usually new construction is significantly higher. But again, I think this is part of the builders not changing the products that they're delivering. So, they might be smaller house that you're getting compared to resale. But anyway, it's worth noting. Let's look at the long term, though. So this is what's super helpful to me when I look at what's happening on home prices. I like to look at them because you see other spikes in their seasonality and things like that of what's going on with home prices. And but this covers a decade. And if you can see from 2012 on, we were super low here because of all the foreclosures and stuff. We basically bottomed out here, and then we proceeded to climb out. And you can make a pretty strong argument that we climbed out at a fairly healthy rate, even though it aggressively went up. We were kind of trying to come back to normal, but by the time we got to about here, we kind of met and exceeded the peak we saw in 2007. Home prices, and then we just kept going. So, fueled by very low interest rates, and then after COVID and dropped even more and all that, it basically forced new action on the property, on the market, and things shot up, and then they raised interest rates right here. Things cooled off. And now we're kind of like figuring out where we're landing, so to speak. Which, interesting enough, if we would have kept this line going, it probably would have been pretty close to where we are now. So maybe we didn't maybe correct enough, but we kind of falling back in line with where we were before, for better or for worse, right? I mean, a lot of times as a homeowner or a property owner, we want home prices to go up. But then, for like our kids and for people trying to get into this market and the health of our economy and workers that need to live here, like we don't want it to get too high, right? We like Idaho being affordable. And the more it gets less affordable, the more annoying it can get if you're trying to acquire properties. Yeah. So this next one is an interesting chart from Pioneer Tile. They do this index where they're looking at all parts of the the market, right? They're looking at demand and supply and permits and new construction. So, they're just looking at the overall health, and basically they come up with a number, and I like to call it like a heat index, because the higher it is, the hotter the market is. And you can see kind of this 10-year trend of how it's still cools off in the winter, just like we kind of do in in a market. And then just went insane around 2020 and stayed pretty hot. And then now look at this down here, right? And so we're still soft, right? And it feels it. If you're out there doing business in the real estate market, it's just not a hot market, okay? You can still sell properties, but if you're going to sell a property, you better price it pretty well because shooting for a super high price right now, it's because it's because there's low supply, might backfire on you because there's just eh, the market's just yeah, you know. So what does this all mean? Okay, so outlook and predictions. Okay, so the optimistic predictions. Okay, so I normally I'm an optimistic kind of guy, right? It's just by my nature. But even my optimistic views are pretty meh as well because all I'm seeing from the rates in the Fed and watching all that kind of stuff is that they're in no hurry to lower interest rates. In fact, they still might raise it further. Basically, the reason is that they don't want to repeat what happened in the mid to late 70s, where they interest rates was screaming up, and then inflation. Sorry, inflation was screaming up then, and then they tried to moderate. Then they thought inflation started to cool off a bit in the late 70s, and they're like, okay, it's better, so they lowered interest rates, and then it swung back up. Right, and so they don't want that disaster to happen. And inflation kind of. I'll show you a chart of inflation in just a minute. So they're trying to balance that out, but they're not trying. But they're trying to also not push the economy into a total recession kind of a thing. But so they're just showing that they're not in a hurry to make that change. So it looks like they're going to need to have many months of inflation being down before they start to make any changes. So it looks like the best case scenario for us to even get rates down into the 5% range might be this winter or spring at the earliest. But that even might be even optimistic based on what they're doing so far and all the things that they're hinting at. So what does that mean? But if that did drop but if rates did drop into the fives, it significantly impacts buyers, right? Because mid sixes versus mid fives plays a big difference on your mortgage. And so if it did, I imagine if it got down to even low fives, I think demand would come back because there's a lot of pent up demand now, right? A lot of people haven't moved that want to move. Because of the high interest rates. So if they do come down, I do feel like demand will surge a bit and get back to kind of pre-2020 levels. We're not kind of like the crazy level, more of a normalized level based on our population. Okay, because right now we're definitely under that. So if you're a real estate professional, I think best case is going to maybe improve by, earlier 2024, best case scenario. But I really don't think this is going to happen. Let me talk about more adverse predictions because as much as I'm trying to stay optimistic, there's just so many dominoes falling in the wrong direction. Okay, and let's talk about that. So I fear, I don't know if it's fear is the right word, but it's seeming more clear all the time that inflation, as much as the Fed is trying to control it with interest rates, is kind of here to stay. It might come down for a little bit, but there's all these things stressing out the aspects of the economy, right? We went for almost a decade of them at least 5, 6, 7 years of them just printing money like crazy. Actually, no, it was about a decade. The Fed just printed a ton of money. Okay, so that didn't help. But they kind of stopped that, right, for now, which is good. And they were kind of taking that money and they were putting it into the bond market and treasuries. And so it was just kind of keeping forcing mortgage rates down. Since they're not doing that again, that's also another reason why interest rates are likely not going to get low again for foreseeable future, low like we got used to, 3% stuff. And then on top of that, we learned from COVID that when the supply chain mechanisms around the world get interrupted it causes all these challenges, right? And when labor gets interrupted, it creates all these challenges, right? And then all of a sudden it's hard to get stuff you're used to getting, and so the supply of things for all kinds of things gets in short supply, and which really drives up the cost. Okay, and so man, it just looks like everywhere I look around the world and everything I'm reading about, everywhere I'm looking, I'm seeing more and more dominoes fall in the wrong direction. For example, we all know about the Ukraine war, right? But as that progresses, and lots of people are paying attention to it as much as they did before. But what's starting to happen now is this whole interruption of supply chains, and not just food stuff. Like that was impacting Ukraine. Is now Russia was not keeping stuff, and that food goes and supplies a lot of places. Around the, a lot, around like Africa and other places, and then those economies there have raw materials and other things that get shipped out. So there's a lot of things being erupted because of that. But now we're even attacking some of the Russian supply stuff. Instead of whole like Black Sea areas like stuff, it's like hard to get anything done and out of there. Which there's a lot of things that the way the whole globalization thing works is that nobody's making all the widgets in on one area, right? Or the whole food product or the whole commodity of something in one area. Even like oil, for example, comes in one form and then it gets refined over here, and then you get all these different steps, right, in different areas. Everyone's specialized, and so now the supply chain's getting interrupted there. So that's one area that's getting interrupted, and then there's all this craziness happening over in China that doesn't get as much coverage as I think should, because China's a mess. It's not getting better. They're having all kinds of issues over there. And there's a lot of manufacturers who make all of our cheap widgets and things are pulling out of China and trying to relocate to North America, which is good. But that process takes years, to happen. And so it's likely, it's all the signs seem to be pointing to is that supply chain issues are going to be a problem for a long time, which creates, it's going to be harder to get things, and it puts this pressure on inflation because there's short supply of things. So hopefully in the long run, it's going to be good for our country, because it's going to force us to do more stuff in-house and bring back more manufacturing, which is good. But we have another major problem here too, and even locally, with the shortage of laborers, people who do the jobs. Like all of our schools seem to say, don't go blue collar, go white collar, for example, right? Go to college, go get a desk job, go play the corporate game. That's where they push most of our youth. And there's not enough of them going into trades. And it's a shame, because that's where the money's at. If you look around town, you can clearly see the contractors are making good money. They have ridiculously big trucks, and they have ridiculously cool boats. I've seen them up at the lake. And they're doing really well because contractors are seriously in demand, and there's not enough of them. So that's something that I think that caused like labor inflation. So when you don't have enough people to do the work, it causes labor inflation. It is skilled work, and it's a major problem, which is keeping the cost up of everything. So this is the problem impacting most consumers, right? Costs are up, and they keep wondering, like, how do you think if inflation comes down, our grocery bill is going to get better? No, right? If inflation comes down, things are going to be cheaper at the mall. No, I don't think so. Not the way everything's heading. So anyway, this is what I keep seeing. And so what this means is that I think inflation's kind of here to stay, which means for the real estate market, I think things are going to be kind of meh for a long time, looks like. It doesn't mean there's not good deals to be found. It doesn't mean you can't sell your house. But it does mean like that there's a whole new normal that we should really expect to be here for a while. The good old days that we had for the previous, 8 to 10 years I don't. I think it's gonna be a while until we get back to that. So anyway, that's what I'm seeing in the market. Okay, so you decide what you want to do for you. I can tell you right now. Oh, let me just show you this inflation thing really quick, because I promised I would. So this is a chart showing inflation for the last 10 years, right? And so you can see how it's down here, hovering around the 2, almost getting to 3%, kind of a thing, and then spiked up over 8. Well, um, I think it's coming down now. But again, for all the reasons I just mentioned, I think this is going to come back up, despite no matter what the Fed does. Okay, I mean, I think they might be able to help it keep it from running totally out of control. But I just feel like this that we saw here, and because of the supply chain issues and labor inflation. Okay, yeah. So what does this mean for you and I and everybody else? That means that, okay, if inflation is going to be much higher for the foreseeable future, that your money is not, if you have anything in a bank account or a savings account, it's not making any money. You're losing money. So you should have any money to, like, if you have any money invested, you probably want to be making more than 7 or 8% on it for you to not be moving in the wrong direction. Yeah, it's kind of crazy to think about it, but it's kind of how the dollar works, right? So it's losing value when inflation is up. Okay, so so this means is that the kind of what I look for now, what I think is the most important, is investments that are not based on hopeful appreciation, but more on what does it actually pay you regularly? What do you get back in your pocket that you can actually spend in today, right? And so things that like basically pay you like cash back, right, or cash flow. This is what I think is really important for the foreseeable future, or the type of investments you want to look at. So if you're in the stock market, I would move on. But if you are there and you insist on being there, maybe get ones that have like dividends that pay out. Okay, you get that cash in your house back into your hand. Now, not to hoard, but you want to keep moving that cash. And so you take that cash back and then you reinvest it there, and now you're multiplying your return. Right? There's lots of ways you can use that money. If you want, and so I'll explain to you. If you want to know how I'm investing, or that, just stay tuned, and I'll take a couple more minutes to tell you exactly what I'm doing with my money. So if you're curious, okay. So my investment strategy. Okay, so I particularly like to target affordable housing in desirable locations. Okay, why? Well, because they're always in demand. Okay, affordable housing is going to be the issue for the next multiple decades. Okay, think about what homes like the average price that we peaked out on the median sale price for a Boise home in the last bubble, 2007, was like 250. We're still in the 200s. Now we're at 500 plus. So it's just so much higher now that it's going to continue to put pressure on getting people to be able to afford housing. So if you can find affordable housing, and so what I do to find it, because it's almost non-existent, is I find things that are not nice, and then I make them nice. They're not nice, or like really not nice, and that's why I can get a deal on them, and then I make them nice, and especially if they're in a good location. And now I got a line of people that want it, so that works good. So I find where there's strong demand for your investment, and then what I like to do is be the bank. And so what I don't like to do is be the landlord. Been there, done it, got the scars and the gray hair or the missing hair to prove it. Okay. And so I like to be the bank. And so what that looks like for me is that I provide financing, especially on properties that are hard to finance. That could be, it could be land. It could be manufactured homes, because those are hard to get financing on. Things like that, right? So that's what I do. And then I like to make sure my equity position is really good on that. So if I buy something, at a low price, and then I fix it up, I make it worth significantly more. Now, I might be here in what I have into it because I bought it here, I did my fix up, right? And then I'm, and then they give me a down payment, drops my basis even lower, and then I give them a loan right about here, but my basis is here. So I often have 35% or more equity on the properties that I'm the bank on, and that's exactly what I recommend because I've done this be the bank thing when people are only putting down a small down payment, and that hurt. I got bit hard because that's back when everybody was walking away from properties. No, I don't want to go through that. I don't recommend any other investors go through that. Instead, you want to be in a solid position where it's actually you're going to do better if that loan fails. You're going to come out more ahead. Okay, that's a good place to be the bank. All right, so that's what I do, and been doing it for a while now. And I stopped being a realtor per se. A couple of years ago. I only do it occasionally, but mostly I'm just full-time investor now, and this is what I'm doing. And if you have money to invest, you can invest with me. Like you can go on and do it yourself, or you can partner together. We can invest with me. So I'll show you a little bit like that looks like. But what's nice the way I set this up is that I'm trying to set up it the way that I would want to be, for myself, right? If I'm going to work with somebody else, it's nice if you partner with me. And again, you can do your own thing, but I do bring on partners, and I like it. You know why? Because it helps me diversify even at a higher level, right? So instead of just me buying this one property, if I go in with another person, now I can get two properties. And if you get another third property, the more investors, the more I can get into more properties. I like that. I like being diversified across lots of properties. But anyway, yeah, if you don't know me that well, I pretty solid track record of success, right? So I can show you that, and especially what I've been doing lately, okay? Because I've been kind of figuring out, I found a good sweet spot of how to do things. And then you get to enjoy not having any of the landlord nightmares if that's what you're dealing with, or if that's what you did in the past, which makes you nervous about investing in real estate. I get it, because who wants that nightmare? And I like it, what I'm doing now, because we're addressing affordable housing. I take homes that nobody wants, then makes it and still provide them at an affordable level that a lot of people want. And if they have struggled to get financing because of the type of product it is or whatever, then I help solve that problem. And you can even set it up for if you want to earn your money. If you're making 9-10% a month, the cash flow's coming in at a great return. You can set up those returns to be tax free if you set it up through like self-directed IRA. I can show you talk to you about how you do that. I don't do that yet because I live off my cash flow, right? Yeah. So I like getting it back in my pocket. But you can do it tax free, which is a great option, especially if you have money that was been sitting in a retirement account anyway, and you move it in something that's more actionable. And what I'm doing basically now is I'm trying to build my retirement fund. I'm self-employed. I've been self-employed for 20 years. I haven't got a W-2 from anyone since 2003, I think. Yeah, it's been a while. Not 2003. Yeah, 2003. Yeah. So anyways, I'm doing these cash flow investments is that I'm trying to create over the next few years until my girls graduate from high school, which is about 3 or 4 years away, is to build up a nice little, 10, 15, 20 grand a month kind of a pension coming in from these investments. That's what I'm doing. So if you want to learn more about what I'm doing, if you have money to invest, reach out to me. Here's my email address. But anyway, I will do another market report here in the next quarter as we see how things are coming along. But I think, honestly, it's just going to stay spongy, for the rest of the year. It's already showing a slightly improvement over it did a couple months ago as far as just like demand. But really, until interest rates come down, I think it's going to stay kind of similar. and it's not bad. It's not terrible. It's just meh, and maybe that's okay. All right. Till next time, I'm Mike Turner. Take care.